Let's get to Richard Flax, who is the CIO at Moneyfarm. Richard, we're counting down to the autumn statement, and the market at this point has been told, look, if there are any giveaways, it's not going to be coming quickly through the system because the Chancellor doesn't want to stimulate inflation, just as central banks seem to be getting ahead of the challenge. What are you anticipating from the autumn statement that will be useful for voters?
And not a huge amount, I think. I think we'll see maybe something on investment taxes. Maybe we'll see thresholds rise a little bit. But I think the Chancellor's in a difficult position. You know, revenue, the tax burden is the highest in 50 years. Investment to GDP is pretty low. And so the Chancellor is trying to think of ways to improve potential growth in the UK, but it's a challenging situation.
This is a great example for other countries when you've got the Conservatives trailing in the polls and arguably need to wrestle back the voter, but just doesn't have any wriggle room when it comes to the economy. What is the inflation problem from here going to look like, do you think, for a lot of countries when there is a problem that you reignite inflation if you stimulate?
No, I think it's very challenging. Look, you can think of inflation at the moment as maybe being at the end of the beginning. Right, so you've had inflation come down from very high levels. Next question for a developed market central bank is how easy is it to get from 3% to 2%? But then the third problem, which is the one that I think you're posing, is what happens if you try to bring interest policy rates down? Do you see is structural inflation going to be higher than it has been over the past 10 or 15 years? And does that create challenges, as you mentioned, for things like debt interest payments, as well as for the household budget?
Richard, I mean, trying to cut interest rates in 2024 is going to be fascinating, considering we still have a handle on inflation, as you're alluding to as well. Do our viewers buy gilts now or not?
Look, I think there are some interesting reasons to look at gilts. Again, the inflation rate does seem to be coming down. And you can say that long-dated gilts have fallen a long way. You obviously have some tax benefits to buying long-dated gilts in some cases. So there are some reasons to think that it should be the case. And we probably haven't seen the economy generally in developed markets slow as much as we might have expected, and we may see more of that in 2024. That could give central banks a bit more room to maneuver than we've seen up until this point.
Richard, thanks for some opening comments on the UK economy and around the autumn statement. We're just going to squeeze in some markets, but we'll come back to some broader picture comments. What we've got on markets yesterday, a lot of focus again on technology around AI. The Sam Altman story at OpenAI and news that he was joining Microsoft was big news for Microsoft stock, which climbed to a fresh record, but also across the boards. We saw again a lot of money pivoting back towards the technology sector. The question is whether it was Sam Altman, this huge focus on AI, or whether it was monetary policy, because we've had a number of positive weeks thanks to the declining yield story. Hopes that the Fed is now done. That's fully priced into markets. There's no rate hike coming this year, but rate cutting from next year, from March, is what the markets seem to be anticipating, and that has unlocked this rally, which again we saw more of yesterday in technology, the real standout sector across the markets. We saw it on the ARK Innovation Fund, FANG stocks, the Magnificent Seven, very much evident in markets. To the dollar. That fading yield story also taking the shine off the dollar. Sterling, euro, both perched high this morning, climbing more than 0.1%, 125.25 roughly on sterling. Euro dollar 109.55 in morning trade, and also knocked off its perch against the Japanese yen. No easy task given the weakness we've seen in that currency over the course of 2023. 150 plus territory we've been in recent weeks. Now 147.57. So significant territory claimed there. Dollar yuan also in focus, but I think market is closely looking at Bank of Japan this week and how it responds to some of the data points domestically. Let's get to the Asian markets more broadly on equities. You can see some of the modest upbeat activity we've had early on just fading. We've given back a lot of that territory and almost flatlining on the Hong Kong and Shanghai markets, still up by about a third on Australia, and stocks over in Japan have been slightly in the red today. European futures and the boards are trading like this, somewhat choppy, a little bit mixed as we head towards the open. So not a lot of appetite this morning. But Richard, can I just come back to what we're seeing on markets, and if I can pose that question to you around the equity story yesterday on Wall Street. How much of the appetite around technology do you think was down to, again, monetary policy, and how much down to the Sam Altman story that was playing out around OpenAI?
Look, I think it's a combination of the two. I think you did see a decent Treasury auction, which is likely to be supportive. But I think all the furore around OpenAI is just a reminder to investors of some of the potential that the market seems to see in the artificial intelligence story, and the ability of that potentially to drive productivity generally and earnings for some stocks in that sector.
Richard, despite the best efforts of the London Stock Exchange and others, the fact is it seems very, very clear that even for non-technology stocks, there are elements of the London market and, to be fair, the European market that trade at a discount to the US market. It's a historical fact, and you and I could go over all the reasons if we wanted to. But more importantly, here's a really basic, big question for you. Is the FTSE 100 value or value trap at 10 times forward?
I think it's value. I think at the end of the day, provided you can see consistent cash flows out of these businesses, and growth is challenging in some of the sectors to which the FTSE is exposed. But I think that if you see consistent cash flows and decent returns out of those businesses, either in the you'll see a recognition of that value either in the public space or potentially in the private market as well.
The problem is, the big old prop, and to be honest, I know it's a ZZ question, but the big old prop was the dividend yield. Yeah, you get these telecoms, which give you 7% plus. You've got the oil sector, the cash flows you just mentioned there as well. But if we're buying a basket, which a lot of our viewers will feel safer doing at the moment, you're getting 3.95 now. And off those lovely fat gilts we just mentioned, you're getting 4.13 as well. That old income support argument's just disappeared, hasn't it?
Look, it has to some extent, and I think it has generally in some parts of the equity market, right? So you can get obviously, fixed income is now a more attractive place to be than it has been for some time, and that's particularly relevant for companies that potentially don't have a huge amount of growth, and that's exacerbated by in a relatively weak economic environment, the ability to manage the cost base and to manage that revenue line as well. So it's about the sustainability of that dividend as much as anything else. So you will see, some challenges to businesses that perhaps have fewer growth engines. But potentially, if you do see an improvement in the growth environment, then some of those headwinds can really turn into tailwinds for some parts of that market.
Richard, why are the European markets not a better bet than the FTSE at this stage? And I'll cite the DAX and the CAC. I mean, you've seen in the market rally recently that the DAX has really taken off. It's got a very steep curve, which we're just not seeing evident in the FTSE at this point. So why not trade the DAX instead of the FTSE at this stage?
No, it's a fair point. Look, European markets have some interesting drivers. Obviously, we saw the benefits of from the luxury goods space earlier in the year, and some of the cyclical industrials that the European markets do have. And so it really comes down to a view as to where you see the greater potential, right? Do you see it in some of the resource names, some of the pharma names that are prevalent in the UK, or perhaps some of the luxury and the industrial cyclicals that you see in Germany? So you can, or in Europe more broadly rather. So it depends a little bit on where you see your preferences from a sector perspective, and that's always been one of the challenges for the European markets generally, where tech is the US market is so much more focused on the tech space, and that's been really one of the big drivers of growth, as we know in the past.
Richard, can I just ask you about monetary policy and what divergence we could see on stock markets globally in 2024 based on that pathway? Because this year has been very similar. We've all gone up aggressively and markets have had to react to that. Then the next point is whether we're at a peak or a plateau. 2024 could bring with it rate cuts. So how do we see markets responding, and will there be divergence in your view?
Yeah, so I think it inevitably depends a little bit. I'm not sure that we'll see huge divergence, at least in the short term. Perhaps as we go out, perhaps we'll see a bit more. I think at the end of the day, some of it is a function of where there is greater scope to cut rates. And so it really breaks down that the US economy is in pretty robust shape, at least based on the latest GDP numbers. The Eurozone and the UK, in perhaps a little bit more of a stagflationary environment. But perhaps we'll see inflation come down further in the US. Perhaps there are fewer rigidities there, and so you could be in a situation where even though the US growth is stronger, the potential to cut rates there is perhaps a little bit greater than investors may currently think. The challenge in the Eurozone, obviously, they have there's only a single mandate there. It's really about inflation. And you have some perhaps more geopolitical challenges closer to home. So it's a difficult environment from that perspective. So I think initially you may not see a huge divergence, but potentially you see it further on in the year.
Nice to see you, Richard. Thank you very much indeed for your time with Karen and myself this morning. Richard Flax, CIO at Moneyfarm.